Now, today we're going to discuss financial ratios. Basically, we're going to focus on important ratios that we have to use when or at any time we are supposed to analyze financial statements of any business, the prospective borrower. Now, remember, when we have what we call lending assessment models, and the lending assessment models can be most commonly the company and the 5 C's, right? 5 C's. So we have company and 5 C's. In both lending models, one of the elements that we need to assess is security of the bank funds as well as the repayment, okay, loan repayment. So remember, the funds that we disburse, okay, the fund that we loan out, we borrow from customers. So what we lend out actually is customers' deposit, and customers' deposit is subjected to demand withdrawal. Therefore, we need to ensure that the loan is repaid on time in order to avoid liquidity crisis to a bank, okay? Because liquidity crisis can interbank into a very, very big problem or trouble. Now, to ensure that at all time bank fund is safe, okay, in the hand of the borrower, we usually require security. But remember, security is not supposed to be the basic criteria for you to issue loans, okay? As a matter of fact, the primary security for any loan is the project that you are financing. This is very important to remember. The primary security for any loan is the project or the business that you are financing. This is the primary security, okay? So if the project you are financing or the business that you are financing should be the primary security, it means this is the one that will ensure timely repayment of the loan. For that reason now, we need to analyze in detail the provided financial statement of the business or of the project in order to determine financial soundness. We need to determine financial soundness of the business. If the business is financially sound, if the business is healthy, then it can fulfill its contractual obligation with no problem. Repayment will be timely, the rate of default will be very low. However, if the business is not financially sound, then there can be high rate or high probability of default, right? So as a banker or as a credit officer, you have a responsibility to determine the financial soundness of the business. And this is the essence of applying or of acquiring the skills of computing some financial ratios. So today we're going to learn how these ratios are computed, interpreted, and the way we can apply them in analyzing the provided financial statements from a prospective borrower. So, what is a ratio analysis? Operating finance ratio are quantitative measures that are used to assess businesses. These ratios are used by financial analysts, credit officers, equity research analysts, investors, and asset managers to evaluate the overall financial health of the business with the end goal of making better investment decisions. Remember, since you are coming from a bank, then you are a banker or credit officer, right? And The fact that you are giving out a loan, okay, it means you are investing. Therefore, you are an investor. So there, now you have been entrusted mandate by your respective bank to invest depositors' fund on behalf of the bank so that you can earn a profit in form of interest. Now you need to use these ratios in order to make better investment decision. Corporate finance ratios are also heavily used by financial managers and C-suite officers to get a better understanding of how their businesses are performing. All right, if you want to analyze the performance of your business from year to year, you can as well use this ratio. Okay, now for us bankers, we're going to focus on the second paragraph. Okay, we need to use ratio to establish financial soundness of the prospective borrower. Why we use ratio analysis? Ratio analysis is a great way to compare two companies that are different in size, operations, and management style. It is also a great way to quantify how efficient a company operations are and how profitable the business is set up to be. Solvency ratios, for example, can be used to analyze how well a company will be able to meet their financial obligations. Basically, there are 4 categories of ratio, and each ratio indicates or will give you an insight of a certain aspect of a business. For instance, liquidity ratio will tell you about liquidity of the business. Gearing ratio will tell you about the leverage aspect of the business. Okay, say capital structure of the business. Is the business highly relied on debt, or the business is equity financed? Okay. Again, there are some other operations of the business, such as selling of inventories, collection of debts, repayment of debts. Okay, now we can use activity ratio, all right, to determine how this business is performing in that aspect. Therefore, ratios are of paramount importance in the analysis. Different companies operate in different industries, each having different environmental conditions such as regulation and market structure. With such factors, a comparison of two companies from different industries might be misleading. This is very important to comprehend. For instance, you cannot compare two companies of the same size which are coming from different industries or different sector. For example, a company that provides financial services cannot be compared with a company that is into manufacturing. Okay. Services are completely different from physical products, goods. All right. Therefore, we cannot use ratio to compare companies coming from these two industries. They are different. We use the ratio to compare companies that come from the same industry. Financial accounting information is affected by estimates and assumptions. Accounting standards allow different accounting policies which impair comparability, and hence a ratio analysis is less useful in such situations. The firm can make some year-end changes to their financial statements to improve their ratios. Then the ratios end up being nothing but window dressing. Of course, here, these are limitations of the ratios, okay? We love to use ratios to analyze these businesses, but ratios have their limitation. This is the first limitation, this is the second, and this is the third. Now, let's focus on the third limitation. Customers are not all the time honest. Sometimes customer can try to cheat, okay? And how do they cheat? Customer will collude with some other accountants to manipulate financial statements. Now, once they manipulate financial statements, what will happen is that using ratio, the business, as a banker, you may conclude that this business is performing while actually it is not. Why? Because the financial statements have already been manipulated. And that's the reason, as a banker or a credit officer, you need to request the business to provide you with audited financial statement. We believe that at least an auditor will not try to manipulate the company financial statements. But I'm not saying that all auditors or all accountants are that ethical. Okay, there has been a lot of ethical misconduct and ethical issues worldwide, not only in our countries. So you really need to be keen, and that's the reason, again, we cannot grant loan based on only analysis or financial analysis or analysis of the financial statements. All right, we grant loan after making sure that the business has qualified in all aspects that we're supposed to analyze or to assess using the learning assessment model, such as company. Remember, character, ability, margin, purpose, amount, repayment, and insurance. So here there are 7 elements. All right, and it's just one element that requires you to use ratios. So you can use other elements as well to make a better decision on whether you should grant or not grant. In case you have suspicion about the performance of the business, find another way around to deal with it. Another limitation of ratio is that ratio ignore the price level changes due to inflation. Why? Because ratios, we calculate ratios using historical cost. In most cases, the borrower will provide you with financial statements of some previous years, let's say 2019, 2020, 2021, and 2022. All right, so today is 2023. This is the current year. Now, most likely the rate of inflation in the 2019 was not the same as what that was in 2020, 2021, and 2022. Okay. Again, accounting ratio completely ignore the qualitative aspects of the firm. You know, ratios are numbers, and numbers are quantitative. All right, but there are some other aspects that cannot be assessed by using the ratio. For instance, the quality of the management. All right, skills of managers, workers, etc. These cannot be assessed using ratios, right? And that's the reason, as I mentioned earlier, that you need to use a suitable lending assessment model in order to be able to establish all these qualities and come into a conclusion on whether you should grant or not grant the request. There are no standard definition of the ratios, hence firms use different formulas for the ratio. For instance, in current ratio, some firms take into consideration all current liabilities, but others ignore bank overdraft from current liabilities while calculating ratio. You see, so this is due to some different accounting standards that are adopted by these companies. Accounting ratio do not resolve any financial problems of the company. They are simply the means to the end, not the actual solution. Ratio will simply give you an insight of what is going on with the company, assuming that the financial statements were never manipulated. All right, so you are the one to come up with a solution on what should be done for the company to improve. Financial ratio analysis and interpretation. Financial ratio analysis is the use of relationship among financial statement accounts to gauge the financial condition and performance of the company. Ratio analysis is used to evaluate various aspects of a company operating and financial performance, such as the efficiency of the company, liquidity of the company, profitability, and solvency. You see? Therefore, using financial ratios, we can be able to tell how efficient the company performs some task. For instance, selling of inventories, collection of debts, repayments of debts, asset utilization, etc. All right. Again, using liquidity or profitability, we can be in a position to tell so far how much profit the company has been making, either by using the assets. Okay. In case of liquidity, we will be in the position to establish the ability of the company to meet its short-term obligations by using its most liquid assets. All right. So this is the essence of these ratios. Ratio analysis is the most well-used technique used by banks when analyzing applications for short-term credit facilities. However, one must appreciate that financial ratios are only indicators. Get explanation from customers when necessary. Remember, I warn you that financial statements can be manipulated, right? Now, if you agree with me that financial statements can be manipulated, then in case you find that the performance of the company signify you that there is some sort of manipulation, then simply ask the business or ask the borrower for clarification. Do not fill the gap for him or for her. Okay, let them explain. The lending banker, in most cases, is interested in the following groups of ratio. Number 1, liquidity ratios. Number 2, profitability ratios. 3, solvency ratios. And last one, efficiency or asset management ratio. Now we're going to discuss these ratios one to the end. Let's begin with the liquidity ratio. Liquidity ratios are used by financial analysts to evaluate the financial soundness of a company. These ratios measure a company's ability to repay both short-term and long-term debt obligations. But in most cases, liquidity ratio will give you information on the ability of the company to meet short-term rather than long-term debt obligation. Liquidity ratios are often used to determine the riskiness of a firm to decide whether to extend credit to the firm. The first liquidity ratio is current ratio, but also there is a quick ratio, cash ratio, and working capital. These are the 4 ratios that you must know how to compute, and then they fall under the liquidity. Now let's begin with the current ratio. The current ratio, also known as the working capital ratio, measures the ability of a business to meet its short-term obligation within a year. The ratio compares total current asset to total current liability. The current ratio looks at how a company can maximize the liquidity of its current asset in order to settle its maturing debt obligation. Now, how do we compute the current ratio? It's easy. All we have to do is to take or to identify current assets from the given balance sheet or financial statements, and also identify current liability. Therefore, current ratio equals to current asset divided by current liabilities. Again, I should insist something. For you to better comprehend the way to compute these ratios, first of all, you really need to be familiar with financial statements. It is very important to be familiar with the financial statement. Why? Because these ratios are computed from different elements of the financial statement. All right. Now, what are the financial statements that we have out there? We have the statement of financial position. All right. Statement of financial position. We call this a balance sheet. Then there is profit and loss account or income statement. All right. These are the key financial statements that we're going to use. But also there is a cash flow statement. All right. So 1, 2, 3 are the most important financial statements. Now, every financial statement mentioned here have different elements. So as a banker or credit officer, you really need to be familiar with these financial statements so that it will be easy for you to know where to find a certain specific element. For example, if you are talking about current asset or current liability, you really need to know where to find them. Are the current asset and liabilities in the statement of financial position, or they are in the income statement or the cash flow? All right. Net profit, for example, costs of goods sold, sales. Where are they? Where can we get them? Are these the elements of financial position, statement of financial position, income statement, or the cash flow? So please be familiar or familiarize yourself with the financial statements, because by doing so, it will be easy for you to know where to find a certain element that you need for computation of your respective ratio. So, to conclude with the current ratio. Current ratio is obtained by taking current asset divided by current liabilities. Now, how do we interpret this ratio? Let's consider this example. Suppose a business has a current asset of 8 million, right? So current asset, I abbreviate as CA, 8 million. And current liabilities of 40 million. Then what is the current ratio? What is the current ratio? Now recall the formula. The formula states that current ratio equals to current asset divided by current liability. Now current asset equals to 80, whereas current liability equal to 40. Therefore, you're going to end up with 2. All right. Now, what does these 2 imply? These 2 imply that the business can pay off its current liabilities twice using its current assets. All right. Look, how do you obtain this ratio? We divide current assets to current liabilities. All right. So if the answer is 2, or let's say if the answer is 3, it means this business is able to repay its current liabilities 3 times using the current assets. That is the meaning. And the benchmark for this ratio actually is supposed to be 2/1. Therefore, if your ratio is 2, 3, 4, then this ratio is good. But if your ratio is less than 2, 1, then that can be a problem. So all we need is to have a ratio that is greater than 1. But what happens if the ratio is, let's say, 20, 15, 30, or 45? Okay. All these figures are greater than 2. So should we say that this business is doing fine? Of course, the current ratio is good, but having these two, this big current ratio, it implies that the business does not utilize cash as it has to. The business is leaving too much excess cash unused. Therefore, this cash is essential in the growth of the company, of this business. Now you need to advise this customer to utilize cash because there's a lot of unused funds here. 20, 15, 30, 45, 60 is too much. Remember, the benchmark, however, is 2/1. Okay, so if this ratio is less than 1 or is less than 2, it's a problem. It signifies liquidity issue with the company. Now let's discuss the quick ratio. Quick ratio, also known as the acid test ratio, measures the ability of a business to pay its short-term liabilities by having assets that are readily convertible into cash. Remember the current ratio. Current ratio is computed by taking current assets divided by current liabilities. This ratio measures the ability of the business to meet its short-term obligation when due by using all current assets. Now, what is the composition of current assets? The composition of current assets are hard cash, cash in bank, marketable securities, inventories or stocks, but also receivables or debtors. All right. These are some of the composition of current asset. All right. Now, current ratio considers all this. All right. But with the quick ratio is slightly different. The quick ratio does not want to consider inventory or stocks. So in another way around, the quick ratio takes out inventory or stocks. It measures the ability of the business to pay or to meet its short-term obligation by using other current assets besides inventory or stocks. Now, these assets are considered quick assets because they can be quickly and easily converted into cash, unlike stocks, because it's difficult to convert the stocks into cash. Why? You need a customer to come to show the will and ability to purchase. All right. So it's difficult. But if you have cash in bank, you can easily make a withdrawal and pay. Okay, that's the meaning. Now, how do we compute this ratio? The quick ratio can be computed by taking cash plus marketable security plus account receivables. Then you divide by current liabilities. Or alternatively, you can do like this. You can take current assets, okay, current asset, subtract inventories, okay, subtract inventory, and then divide by current liability. I say again, quick ratio can be computed by taking current asset subtract or minus inventory. All right, these are the current assets minus inventory, and then divide by current liability. Now, how do we interpret this ratio? Again, consider this example. If a business has a cash of 20 million, marketable securities of 10 million, and account receivables of 18 million, while the current liabilities is 25 million, then what will be the quick ratio? It's easy. All you have to do is to sum up all current assets and divide by the current liability, and eventually you're going to end up with 1.52. So you see here, you have cash, you have marketable securities 10 million, and you have debtors 18 million. Therefore, 20 plus 10 plus 18, then the whole thing you divide by current liabilities, which is 25 million. You're going to end up with 1.52. Now, what does this imply? 1.52 means that the business can pay off its debt, short-term maturing obligation, 1.52 times by using its most liquid asset. By using its most liquid asset. And what are the most liquid assets? Cash, bank, and marketable securities. All right, plus the debtors or receivables. A quick ratio greater than 1 strongly implies the financial well-being for the company, as it shows that the company can repay its short-term debt obligation with only its liquid assets and continue to survive. Remember, we have taken out inventory or stocks. Therefore, a quick ratio like this one, 1.52, implies that this company is financially sound in terms of liquidity, because it can repay its short-term maturing obligations 1.52 times without having to consider or to depend on the selling of stocks or inventories. This is the meaning. The third ratio under same category of liquidity is the cash ratio. Cash ratio, sometimes referred to as the cash asset ratio, measures company's ability to pay off its short-term debt obligations with cash and cash equivalents. Compared to the current ratio and the quick ratio, the cash ratio is a stricter, more conservative measure because only cash and cash equivalents are considered. And cash and cash equivalents are simply company's most liquid assets. Cash equivalents are assets that can be converted quickly into cash and are subjected to minimum level of risk. Now, what are the examples of cash equivalents? These are saving account. Saving account simply means money in the bank. So sometimes in the balance sheet, they will simply write bank. Okay, but also there are some marketable securities. Marketable securities can be treasury bills or any other money market instrument. Now, what is the formula that we use to compute the cash ratio? The formula is you take the summation of cash and cash equivalents, you divide by current liabilities. Now, as in the case of interpretation, the cash ratio indicates the percentage of a company's short-term debt obligation that cash and cash equivalents can cover. If a company, for instance, has a cash of 10 million, okay, so this is money in, this is cash, 10 million, marketable securities, treasury bills, 5 million, and the current liability in total of 25 million. Then what is the cash ratio? So you see here, treasury bills are worth 5 million. Cash, whether it's cash in the bank or hard cash, is 10 million. In total, it gives you 15. And the current liability of the same company is 25. Therefore, to compute cash ratio, all you have to do is to take 15, you divide by 25, you're going to end up with 0.6. So you can see that a company can pay 60% of its debt. Okay, if you multiply this one by 100, you're going to end up with 60%. Therefore, the company can pay 60% of its current liabilities by using cash and cash equivalents. Creditors prefer a higher cash ratio as it indicates the company can easily pay off its debt. For instance, in this case here, you can see that the company can pay 60% of its short-term obligations. So 40% can be covered by other items of the current assets which were not included in the computation of cash ratio. For example, debtors, which are receivables, but also inventory or stocks. Now, there is no ideal figure, but a ratio that is between 0.5 to 1 is usually preferred. Okay, cash ratio, we will prefer the cash ratio to be between 0.5 and 1. Okay. Now, the last ratio under this category is the working capital. Working capital is a financial measure which calculates whether a company has enough liquid assets to pay its bills that will be due within a year. When a company has excess current assets, that amount can then be used to spend on its day-to-day business operations. It is a measure of a company's short-term liquidity and is important for performing financial analysis, financial modeling, and managing cash flow. Now, how do we compute this ratio? Working capital, it's easy. Basically, it's not a ratio, forgive me. But to compute working capital, it's easy. All you have to do is to identify current assets, then identify current liabilities, and afterwards, take the difference. Therefore, for instance, if in a balance sheet, total current assets is, let's say, 2 million, and total current liabilities is just 500,000, then working capital will be the difference between these two figures, which will be 1.5 million. All right, that's how you compute this ratio, the working capital. Now, I insist, it is very important to understand or to be familiar with the financial statement, because by familiarizing yourself with the financial statement, it will be easy for you to know where to go or on what part of the financial statement you'll be able to find, for instance, the current assets, current liabilities, inventories, etc. It's very, very important. Now, all figures that we need to compute, all figures necessary for the computation of all ratios under liquidity, that falls under liquidity, okay, can be found in the statement of financial position or the balance sheet. Okay, the BS, the balance sheet. And the good news is that the balance sheet, okay, the balance sheet has the following elements. Now, the statement financial position has the following elements. The first one is the asset, which contains, number one, current asset, and number two, non-current asset, alternatively known as the fixed asset. And here you're going to have the total assets, right? Second element, liabilities. Therefore, under liabilities, expect to have, again, current liability, and number two, non-current liability. Then the total. Okay. Let's focus our attention on the profitability ratio. Profitability ratios are simply financial ratios that you as a banker can use to measure and evaluate the ability of a company to generate profit. Okay, so if a company is your prospective borrower, as I mentioned earlier, first of all, you need to ask them to provide you required documents. And one of the documents is going to be the financial statements. Now, from the financial statements, you need to compute profitability ratio in order to see the ability, the capacity of this company or this business to generate income. Remember, from company, there is repayment, okay? You're supposed to assess the ability of this business or the project that you're financing to repay back the borrowed fund. We need timely repayment. Okay, so profit is the one that can tell you the ability of the company to repay back the loan. There can be some other aspects of the company that can as well be used to measure the ability of the company to repay. But the first thing that you should consider is the ability of the company to make a profit. A company that makes a profit will have a very minimum rate or probability of default. A company that does not generate a profit, the company that has been making loss, will have no ability to repay back its financial obligations. So this ratio is of paramount importance. Again, profitability ratio can indicate to you the way company utilizes its assets in order to generate profit and the value to the owners of such business or company. Now, what are the ratios that falls under the category of the profitability ratio? As a banker, you need to know how to compute the return on equity, which is sometimes abbreviated as the ROE. Return on asset, also abbreviated as ROA. return on capital employed, abbreviated as ROCE, and the gross margin ratio. All right. Last, operating profit margin and the net profit margin. So these are the ratios that falls under the category of profitability ratio, and so you really need to know how to compute them. Remember, we are not interested with only the computation aspect of it. You are as well supposed to interpret, because at the end of the day, the number that you get following the computation is supposed to correctly be interpreted, so that at the end of the day, you will be in a position to tell on whether the company is financially sound, or it has been financially sound, or it will be financially sound in the future, and subsequently be able to repay the debt or to meet its financial obligations. Now let's begin with the first ratio, return on equity, ROE. The return on equity is a measure of company's annual return divided by the value of its total shareholders' equity, and it is usually expressed in percentage. How do we compute this ratio? It's simple. All we have to do is to consider net income, and then we divide by shareholders' equity, and the whole thing is multiplied by 100 in order to get percent. Now, as I mentioned earlier, you need to familiarize yourself with different elements of these financial statements. Where do we get the figure for the net income? This is from the profit and loss account or from the income statement. All right. And what about shareholders' equity? This one is from the financial statement of financial position or from the balance sheet. All right. So if you are familiar with different elements of the financial statement, it will be easier for you to compute these ratios, because you know where to go in order to obtain the required figure. ROE equals to net income divided by the shareholders' equity. Now, how do we interpret the return on equity? Again, it's easy. The return on equity provides a simple metric for evaluating returns. It does so by comparing a company's ROE to the industry average. It is possible to pinpoint a company's competitive advantage or a company's lack of competitive advantage. As it uses the net income as the numerator, return on equity looks at the firm's bottom line to gauge overall profitability for the firm's owners and investors. As an investor, this is an essential ratio to look, as it ultimately determines how attractive an investment is. Return on equity is a product of asset efficiency, profitability, and financial leverage. When computing this ratio, simply remember the formula. And through remembering the formula, it's going to be easy for you to tell or to interpret. The ratio can be computed by taking net income to shareholders' equity. Okay. So, this is the question that you need to ask yourself. If you are taking net income, you divide by equity. For this business to be attractive, what would you want to be? Let's say the answer for this one is X. Now, what would you want X to be? Would you want X to be high, or you want X to be low? A rational investor will prefer X to be as high as possible, because if the ROE, hereby represented by X, is bigger, then this business is worth investing. It's highly attractive. But if the ROE is less and less and even less, then this business is not doing fine. So do not invest. Another ratio is known as the return on asset, ROA. A return on asset is a type of profitability ratio that measures the profitability of a business in relation to its total assets. This ratio indicates how well a company is performing by comparing the profit, that is the net income generating, to the total capital it has invested in the assets. Again, for this ratio, the higher the return, the more productive and efficient the management is in utilizing the economic resources. How do we compute this ratio? It's easy. All you have to do is to take net income, you divide by the total assets. Again, you should remember net income is from the income statement, whereas total assets comes from the balance sheet. Once you remember this, it's going to be easier for you to know where to get the figure to use for computation of this ratio. Net income from the income statement and total assets from the balance sheet. Now, how do we interpret this ratio? The return on asset formula is an important ratio in analyzing a company's profitability. The ratio is typically used when comparing a company's performance between periods, or when comparing two different companies of similar size and in the similar industry. Remember, this is very important, okay? Industry. Don't compare company that comes from different industry. If you do so, then your interpretation will be misleading, or the ratio will mislead you. So companies need to come from exactly the same industry for the ratio to be useful. Now again, recall the formula. What do we need to compute this ratio? What we need in the computation of ROA is the net income and total assets. Therefore, if this is the formula, then what will you want for X to be? Do you want ROA to be big, or you want it to be small? Basically here, you want ROA to be as big as you can and not small. Okay. Now, another ratio is known as the return on capital employed. This one is abbreviated as ROCE. This is a profitability ratio that measures how efficiently a company is using its capital to generate profit. Okay, this ratio measures companies' usage of capital in order to generate profit. The return on capital employed is considered one of the best profitability ratio and is commonly used by investors to determine whether a company is suitable to invest in. So as a banker, always know how to compute the ROCE, because this one can best tell you the condition of the business and on whether you should or you should not loan out bank funds to this particular business. Now, how do we compute this ratio? It's easy. All we have to do is to take the figure for earning before interest and tax, abbreviated as EBIT. Earning before interest and tax. You divide this by capital employed. Now, how do you get capital employed? Capital employed equals to total asset minus current liabilities. Okay, total asset minus current liabilities. Earning before interest and tax. This figure can be obtained from the income statement. Okay, this one comes from the income statement, whereas capital employed, all these two figures comes from the balance sheet. Now, how do we interpret this ratio? The return on capital employed shows how much operating income is generated for each money invested in capital. A higher ROCE is always more favorable, as it implies that more profits are generated per capital employed. Therefore, remember this, that you love for the ROCE to be higher and not low. Okay. Other profitability ratios, such as the return on asset, return on invested capital, and return on equity, should be used in conjunction with the return on capital employed in order to determine whether a company is truly profitable or not. Remember, earlier I told you that there is an issue of manipulation of these financial statements. So try to compute different ratios, and also try to use your skills to establish on whether other aspects of the company or of the borrower supports the result that you are getting from the ratios. Another ratio is known as the gross margin ratio. The gross margin ratio is also known as the gross profit margin ratio. Okay, this is as well known as the gross profit margin ratio. This is a profitability ratio that compares the gross margin of a company to its revenue. It shows how much profit a company makes after paying off its cost of goods sold. The ratio indicates the percentage of revenue that the company retains as a gross profit. So naturally, we will love for this ratio to be bigger and not small. Gross margin ratio equals to gross profit divided by total revenue. Okay, so again, you need to be able to tell where to obtain these figures. Gross profit is obtained by taking total revenue minus cost of goods sold. All these figures comes from the income statement. Okay, likewise, total revenues comes from income statement. All right, therefore, once you know where you can obtain these figures, it becomes easier for you to compute this ratio. And remember, we will prefer for the gross margin ratio to be higher and not otherwise. In some instances, a lower gross margin ratio does not necessarily indicate a poor performing company. It is important to compare gross margin ratios between companies in the same industry, okay, rather than comparing them across industries. we need to focus in the same industry. If it's service, then service industry. If it's manufacturing firm, then manufacturing industry. Otherwise, your interpretation might be misleading. For example, a legal service company reports a high gross margin ratio because it operates in a service industry which have a very low production cost. A legal service industry or a legal service firm most likely will need some few computers, stationaries, and printers. Whereas, if you are to compare this with a firm that is in manufacturing business, it needs some plants, machines, considerable number of laborers, okay, space, and raw materials, all of which are costly, okay, costful. Therefore, that's the reason we strongly recommend comparison to be of firm that comes from exactly the same industry and not otherwise. Another ratio is known as the operating profit margin. Operating profit margin is a profitability ratio used to calculate the percentage of profit a company produces from its operations prior to subtracting taxes and interest charges. This ratio is calculated by dividing the operating profit by total revenue and is expressed in percentage just like other ratios. The margin is also known as the EBIT, earning before interest and tax. Now, how do we compute this ratio? This is the formula. To get the operating profit margin, we take the EBIT or operating profit divided by the total revenue. But how do you get EBIT or operating profit? You need to take total revenue and from it subtract cost of goods sold plus any other operating expenses, then subtract depreciation and amortization if provided. I'll say again, to get the earning before interest and tax, all you have to do is to subtract the following from the total revenue: cost of goods sold, operating expenses, depreciation and amortization. Subtract these from total revenue in order to arrive to the operating profit or EBIT. And then divide your answer to the total revenue. Then you end up getting the operating profit margin. Now, how do we interpret this ratio? The operating profit margin calculation is the percentage of operating profit derived from the total revenue. For example, if from your computation you end up getting 15%, what does this really mean? It means that the operating profit margin is equal to 0.15 operating profit for every single gain of revenue. From every gain, okay, from let's say 1 shilling, okay, then there is 0.15 as the operating profit margin. The operating profit margin provides an insight into how well the target company performs in comparison to its peers, in particular, how efficiently a company manages its expenses so as to maximize profitability. Another ratio is known as the net profit margin. Net profit margin, also known as the profit margin or net profit margin ratio, is a financial ratio used to calculate the percentage of profit a company produces from its total revenue. This ratio measures the amount of a net profit a company obtains per shilling of a revenue gained. The net profit margin is equal to net profit, also known as the net income, divided by the total revenue, and this ratio is expressed in as percentage. Here is the formula. Net profit margin or net profit margin ratio or profit margin ratio equals to net income. Okay, net income is also known as the net profit. This figure comes from the income statement. So we take net income, we divide by the total revenue. Okay. Again, the total revenue can be obtained from the income statement. And then the whole thing needs to be multiplied by 100 in order to express the net profit margin in percentage. So, how do we interpret this? What will you prefer for the net profit margin to be? Remember, the net profit margin is calculated by deducting all company expenses from its total revenue. The result of the profit margin calculation is a percentage. For instance, a 10% profit margin means that for each shilling of a revenue, the company earns 0.1 as a net profit. Revenue represents the total sales of the company in a period. It's very important. Sometimes you won't find the word revenue, but you'll find total sales. The typical profit margin ratio of each company can be different depending on which industry the company is operating. Now that we are done with the profitability ratios, let's skip now into the leverage ratios. Leverage ratios represent the extent to which a business is utilizing borrowed money. Leverage ratios are sometimes called gearing ratio. Okay. Leverage ratios are alternatively known as the gearing ratios. These ratios evaluate companies' solvency and the capital structure. Okay. In some other literatures, they will refer these as the solvency ratios. Okay. So we use these three words interchangeably: leverage ratios, solvency ratios, or gearing ratios. These ratios provide an indication of how the company's assets and business operations are financed. Remember, financing of the company. The financing of the company or the capital structure, okay, capital structure of the company can be equity. The company can be equity financed. The company can rely on debt, so debt financing, or it can be mixed. A mix, that means a mix of equity and what? And debt. So the gearing ratios are the one to tell you what's going on with the financing of the company. Having a high leverage in a firm's capital structure can be risky, but it also provides some benefits. We're going to see this. Now, what are the ratios, important ratios to compute and the leverage ratios? First, the debt to equity ratio. Second, equity ratio. Third, debt ratio. Now, let's begin with the debt to equity ratio. The debt to equity ratio is a leverage ratio that calculates the proportion of a total debt and liabilities vis-a-vis total shareholders' equity. Okay. Debt to equity, just as the name depicts, debt to equity. Okay. Debt to equity. This is the ratio that calculates the proportion of total debt, okay, and liabilities versus total shareholders' equity. The ratio compares whether a company's capital structure utilizes more debt or equity in its financing. The ratio looks at total debt, which consists of short-term debt and long-term debt, and other fixed payment obligations, if any. Okay, now fixed payment obligations can be a capital lease. Now, to calculate this ratio, all you have to do is to sum all companies or all business debt, and you divide them to shareholders' equity or total equity. Now, in the case of interpretation, what will you prefer? You have debt on top and total equity. Would you prefer for the debt to equity ratio to be a big number or just a small number? Consider the following example. If the total debt of a business is 50 million, while the equity is 120, okay, what will be the debt to equity ratio? Recall the formula. Debt to equity ratio equals to total debt divided by total equity. Now, from this question, we are being told that the total debt is 50 million, whereas the equity is 120. Now, if you are to do the math here, you're going to end up with 0.42 or 42%. Now, what does this mean? It means that the firm has 42 cents in debt for every shilling of equity. Okay? For every shilling of equity, there is a debt of 42 cents. This is the meaning. Now, I ask you, what would you prefer? This figure to be bigger or small? Actually, we prefer for this figure to be small because the higher debt equity ratio indicates that the firm is highly leveraged. And if the firm is highly leveraged, it implies that the firm has over-reliance on the debt. It's highly financed the debt. Therefore, if this business approach you for a loan, okay, if you disburse, if you grant the loan request, it means you are going to add some more burden over the shoulder of this business. I say again, if such a business has approached you asking for a loan and you grant the request, automatically what you are doing is that you are going to add some more loads, okay, over the shoulder of this business. And so if the business will be highly leveraged, most likely it won't be able to repay its obligations. But sometimes The leverage will have some benefits, particularly in the instances of tax deductions on interest expenses. But there are some risks that are associated with these expenses. Thus, leverage is preferable for companies with stable cash flows, but not for companies in decline. Now let's see the equity ratio. The equity ratio is a leverage ratio that calculates the proportion of a total shareholders' equity versus total assets. The ratio determines the residual claim of shareholders on a business. It determines what portion of the business could be claimed by shareholders in a liquidation event. Okay, we all know the liquidation, and remember, during liquidation, what happens? During liquidation, first of all, a company may collapse or will bankrupt if it happens that the debt, okay, exceeds assets. Right? Now, in liquidation process, what happens is the liquidator will sell all assets. Okay, will sell all assets of the company and use them to repay debt. Now, with this ratio, we want to see what portion of these assets will be claimed by shareholders, the owners of the company, in the event of liquidation. So, remember the following accounting equation from the balance sheet. Okay. Primarily, you should remember this, that assets equals to liabilities plus what? Equity or capital, right? Now, if we are to rearrange this formula, we're going to end up with this one, which says equity equals to assets minus liability. By using this as the numerator of the equity ratio, the ratio can be rewritten as asset minus liabilities divided by assets. In other words, it will be the percentage of a total asset after all liabilities have been subtracted. What remains is what will be payable for shareholders. For example, if company XYZ has a total of 15 million in total shareholders' equity and the total assets are equal to 50 million, then the equity ratio of this company will be 0.3. Another ratio under this category is known as the debt ratio. Debt ratio, also known as the debt to asset ratio, is a leverage ratio that indicates the percentage of assets that are being financed with debt. I'll say again, with the debt ratio, we want to determine the percentage of assets of the business or company that are financed by debt. All right, and that's the reason we call it debt to asset. And as the name depicts, all you have to do is to take total debt divided by total asset. The higher the ratio, the greater the degree of leverage and hence financial risk. Remember earlier I told you about bankruptcy of the company. Okay, a company can easily bankrupt if it has more debt. Okay, if debt exceeds assets. All right, whenever or when we are in the situation where the debts are more than the assets, the company will bankrupt. So You want this ratio to be low, not high. Why? Because assets of the business are the one that are supposed to be used to pay debts. The debt ratio is commonly used by creditors to determine the amount of debt in a company, the ability to repay its debt, and whether additional loans will be extended to the company. Because you as a banker should know this, okay, from the formula. I've mentioned that it's total debt you divide by total assets. But we all know that assets are the ones that are supposed to repay debts, okay? Now, suppose that from your computation, the debt ratio is, let's say, 60%, okay? Now, if you are to add a loan, okay, if you are to grant loan request to this company, it means liability or the debt is going to increase. And once this figure has increased, and so will the ratio. Remember, total debt equals to short-term debt or short-term liabilities plus long-term liabilities. So if you grant a long-term business loan to this company, it means total debt will increase. Now, once the total debt has increased, while total assets are still the same, okay, same assets, while debt is increased, then automatically the debt ratio will spike up. Now, if it goes up, the company will be overwhelmed and hence will fail to meet its contractual obligation. Okay. Now, how do we compute this debt ratio? As I mentioned earlier, all you have to do is to take a summation of short-term debt and long-term debt. So simply say total debt. Total debt, then you divide by total asset. Then you get total debt ratio. What we need is the debt ratio to be low. Okay, because if it is high, then it signifies problem to the company. So please do not provide a loan to a company that is highly leveraged. How will you know the company is highly leveraged? Look at the debt ratio. Okay. If the ratio steadily increases, it could indicate a default at some point in the future. The prospective borrower or the borrower will provide you with some financial statements of some years. Okay, it can be 2 years, let's say 2020 and 2021, or 3 years, 2022. So compute debt ratio for year 1, year 2, and year 3, and then make a comparison. If the debt continue to increase, it signifies a problem. But if the debt ratio decreases, it signifies improvement. So make your decision based on what the ratios are telling you. Now, a ratio equal to 1 means that the company owns the same amount of liabilities as its asset. This means this company is highly leveraged. So please do not grant the loan request. Okay. Why? Because if all creditors claim to be repaid, that company will simply repay all creditors and close business. Why will the company close business? Because all assets have been used to repay the debt. So there will be nothing to do business for. Remember, assets also are the ones that are used by the business, okay, to run different operations. A ratio greater than 1 means that the company owns more liabilities than the asset that it owns. It indicates that the company is extremely leveraged and high risk to invest. So, if you give loan to such a company, you should expect an immediate default because the company is overwhelmed with the debts. And remember, I'm going to say again and again, what is the situation or what is bankruptcy? Bankruptcy occurs when debts exceeds assets, right? So when debts exceeds assets, then the company is going to end up bankrupt. The last category of financial ratios are known as the efficiency ratios. Now, efficiency ratios are used to measure how well a company utilizes its assets and resources. These ratios generally examine how many times or how long it takes for a business or company to fulfill a certain specific segment of its operation. For instance, collection of debts or repayment of debts, selling of stocks, inventories, all right, or asset utilization. All right, so efficiency ratios, also known as the activity ratios. Activity ratios. So efficiency ratios, also known as the activity ratios, are responsible to measure how long it takes for a company to fulfill these tasks. Now, what are the ratios that we need to compute under this category? First one is the accounting receivable turnover. Second, account receivable days, asset turnover ratio, inventory turnover ratio, and inventory turnover days. All right. Now, let's begin with the account receivable turnover ratio. The account receivable turnover ratio, also known as the debtors turnover ratio, measures the number of times over a specific period, usually a year, that a company collects its average accounts receivable. What is the accounts receivable? Accounts receivable simply means debtors. Okay, so with this ratio, we want to measure how many times in a year. For example, a company collects money from the debtors. The account receivable turnover ratio can also be manipulated to obtain the average number of days it takes to collect credit sales from customers. This is known as the account receivable days. Okay, so if you are asked to compute account receivable days, you should know that it's going to be different. Okay, because there is something that we need to add to the formula in order to get account receivable days. Now, what is the formula to use? Account receivable turnover ratio is obtained by taking net credit sales divided by the average account receivable. Okay, the net credit sales divided by average account receivable. To calculate this ratio, The following formula are also necessary. Net credit sales equals to credit sales minus sales return minus sales allowance. Okay. But in most cases, if you are using the financial statement, let's say the balance sheet, you'll have the definite figure. For instance, you'll have the exact amount of either the debtors or creditors. Okay, they're all shown in the balance sheet, so you can easily get these from there. Now, how do we interpret this? Consider the following example. A business has a net credit sales of 800,000 at the end of the year. In January and December, the account receivables are 64 and 72 respectively. What will be its account receivable turnover ratio for this fiscal period if the number of days in a year, accounting number of days, is 365 days? It's easy. Remember the formula. All you need is to consider the net credit sales and you divide by the average of the receivables. Now here we get 11.76. Okay. Now this implies that the company collects its account receivable about 11.76 times in a year. This number should be compared to industry average to see how efficient the company is in collecting payment versus its competitors. So in another way around, we do not have a benchmark, a specified benchmark for this. Rather, you need to compare with the industry average. But how about account receivable days? It's easy. Account receivable days are the number of days on average that it takes for a company to collect on credit sales from its customer. So, from the previous formula, all you have to do is to take or to consider accounting number of days in a year, for instance 365, and you divide by account receivable turnover. Remember in the previous example, we obtained that it was 11.76. Therefore, to get the account receivable in days, all you have to do is to take 365 divided by 11.76. Once you do so, you're going to end up with 31.04 days. Let's say 31 days, meaning that it takes 31 days on average for the company to collect its debts or receivables. Again, there's no benchmark for this ratio, so you need to compare to the industry average. Now let's see asset turnover ratio. The asset turnover ratio is also known as the total asset turnover ratio. It measures how efficient a company uses its assets to generate sales. This ratio looks at how many shillings in sales is generated per shilling of a total asset that a company owns. What is the formula to compute? It's easy. All you have to do is to take net sales divided by average total assets. Of course, in the balance sheet, you'll simply find the figure for total assets. Okay, so net sales divided by total assets. If you're familiar with the financial statement, you know where to get the net sales, you know where to get the total assets from those financial statements. Okay. For example, a company has net sales of 100,000 for the year. On December 31st, the company had a total asset of 65, while on January 1st, the total assets are 57. Then what will be the asset turnover ratio? It's easy. All you have to do is to take the 100,000 divided by the average of 65 and 70, 65 and 57. Okay, so here you'll get a certain answer, and then all you have to do is to take 100 divided by that number right there. So at the end of the day, you're going to end up with 1.64. What does this imply? This means that for every shilling of total asset, the company generates 1.64 in net sales. Now here, we really prefer this figure to be high. Okay, we really prefer this figure to be high because the higher the figure will indicate how efficiently assets are being utilized to generate sales. Inventory turnover ratio. The inventory turnover ratio measures how many times a business sells and replaces its stock of goods in a given period of time. This ratio looks at cost of goods sold relative to the average inventory in the period. The ratio indicates how efficient a business is at clearing its inventories or at finishing goods in shelf, at making sales. Okay, inventory turnover is all about efficiently making sales. How do we compute this ratio? It's easy. All you have to do is to take cost of goods sold, COGS, okay, divided by average inventory or inventory. Okay, so again, you need to know cost of goods sold comes from the income statement, whereas inventory or stocks comes from the balance sheet. Now, how do we interpret this ratio? Consider the following example. A company has a cost of goods sold of 3 million in a fiscal year. On December 31st, the company's inventory was 350, while on January 1st, the inventory was 260,000. What will be the company's inventory turnover ratio? Recall the formula. Then all you have to do is to take the 3 million divided by the average of inventory. Okay, so 350 plus 260 divided by 2, and then 3 million by that average, you're going to end up with 9.84, implying that the company sold its entire stock of inventory 9 times, or let's say 10 times in a fiscal year. Additionally, the inventory turnover ratio can be manipulated to give inventory turnover days. The average number of days it takes to sell an entire stock of goods can be computed by putting into consideration the total number of days in accounting year, and you divide by the inventory turnover ratio. So if a year accounting number of days is 365 and the inventory turnover ratio is 9.84, once you divide, you'll end up with number of days that are required. So as I mentioned earlier, from the previous example, to get inventory turnover in days, all you have to do is to consider now accounting number of days in a year divided by 9.84, and you're going to end up with 37.1, implying that it takes the company 37 days on average to sell an entire stock of inventory.